And good afternoon. My name is Randy Price. His name is Matt Price. We are the Price Group, and welcome to our first webinar of 2025. We've titled this Themes for Investing in 2025. And number one, tongue-in-cheek might be to stay warm till the warm weather gets here, but certainly been an interesting time. We have people in Houston and from all around the country, but it's been an interesting time to be in Houston here the past couple of days, but I think the warmer days are ahead of us. So who are we? We are the Price Group, family owned and operated, 50 plus years of experience, follow a fiduciary standard, and our specialty is retirement. We do these webinars with a sort of a focus on people either retiring or already retired, to give you perspective, to give you information, and to help you with the complex set of information that's coming your way about where we are at this very interesting time in history. So if we're on our game, probably about 20, 25 minutes. We thank you again for being here, and hope this will be helpful to you as you look at 2025. And here we go.
And quite a few clients on the call. There are a few people who are not clients, so just as a way of also introducing who we are for those that are not as familiar, Randy's gotten quite a few awards from Barron's, Forbes, Financial Times over the years. Randy, myself, and Maddie Kearns are all CFP, Certified Financial Planners. Randy and myself being Certified Investment Management Analysts from the Wharton School of Business. And a big part of what we do is communicating, written communication by the way of email. These webinars, when markets do get choppy, our promise is we're going to over communicate and write in the format of what we call thoughts on the market to let you know what we're thinking and why we are thinking it. But our firm's steward partners, based off the biblical definition of stewardship, Raymond James is our custodian where client assets are held. Raymond James has been a really good partner. They're fiscally conservative, which we do appreciate given the nature of their business, and have enjoyed working with them. So Randy, give us an overview of what we're going to be talking about today.
Yeah, there was certainly a lot to consider here for 2025. If you haven't picked up a newspaper or turned the TV on, quite a bit going on. We've broken it down the best we could here to number 8 of 8 things. One, optimism overload, and there is a question mark behind that. The U.S. economy, deal or no deal, sort of a takeoff of Shark Tank. Monetary policy, which is always a topic for discussion, disinflation, inflation. What is the Federal Reserve doing? Where will they go from here? Fixed income, are we range bound as far as interest rates? The 10-year U.S. government bond this morning, this afternoon, right about 4.6%. The stock market, equities, is the price earnings ratio where it should be? International equities, will the U.S. continue to outperform? We think number 7 is sort of a given, but we wanted to make that point and be quite bold about that, is be selective. This is a especially critical time, especially for folks that are close to or at retirement. And then number 8, our foundational thought process. If someone says, what's your secret sauce? Our secret sauce, one of them is planning. Your live well plan matters. Why? Because you want to live well. And again, we're not going to just based on chance or hope or luck, but we're looking for clarity. Clarity leads to confidence. Confidence leads to comfort. So those are our top 8. We could have gone on from there, but let's go and talk about optimism. You've got consumer and business optimism elevated. The slide here was ahead of the Trump administration, and they're often running small business confidence, CEO confidence, consumer confidence, investor confidence. That chart on the right is just off the charts. The market rallied so much so quickly, took a little bit of a snooze over the Christmas break, and now looks like we're back on an upward pattern. But there is confidence based on a number of issues going forward here with the new administration. Bullish sentiment is not always contrarian. It's interesting. Sometimes you expect the market goes up for the right reasons, or the market goes up for the wrong reasons, or vice versa. But this is looking at the S&P performance based on what we call the bull bread spread ranges. Currently a little bit over 11.5, and based on this, the market is probably going to be on this prediction right short of 10% higher over the next 12 months. Now, that is not a guarantee. That is not a set in stone. That is an assumption based on historical information, garbage in, garbage out, and obviously subject to change based on extenuating circumstances. So again, our thoughts are that the market is positive, but as we've talked about, if you've been with us before, several things from geopolitical tension to the debt to inflation, probably the top three that are worrisome for the market and subject to change. Who predicted, raise your hand, COVID and just the tremendous havoc that caused on the stock market just a couple years ago. So we are cautiously optimistic, but always realist and always relying on facts to put our base case in place. And if that changes, we will be here to revise that. And again, as Matt indicated, our emails are there to give you perspective. And if something changes, you will hear from us.
So let's look here at the U.S. economy. A few positives there on the right-hand side of this chart, a few negatives on the left-hand side of the chart. And the four blue shaded negatives, the recession, inflation at 5%, a weaker consumer, and a negative job growth, our humble opinion, for the biggest negatives have partially, if not fully, been taken off the table. So people have been calling for a recession now for over 2 years. That hasn't happened. Inflation is down from at its high of 8 to 9% down to a little less than 3%, 2% and change. People are talking about how the consumer has gotten weaker. We just haven't seen that coming out of the holiday season over the past few months. And negative job growth. We got a great job growth number here earlier this month. So a lot of that has been set aside. Now, we don't know what we don't know. Like Randy said, he used COVID as an example, but there could be World War III. China could drop a nuclear bomb on someone. Go down the list of things that are possible, but not necessarily probable. And so we're going to make investing decisions on what we think is probable, not the things that possibly could go wrong. And as we look here, a healthy economy in 2025, kind of briefly got some of the information from the previous slide there, but we think the overall economy, or the GDP, the gross domestic product, the output of the U.S. economy, should be in that 2.5% range, slightly lower than what we saw last year. But the consumer, we think, continues to be healthy. Fiscal policy has a little bit of a tailwind. We think artificial intelligence is going to be a catalyst for the overall economy, just in job creation. Deregulation is something that Trump has talked a lot about, making it easier to do business. And then the Federal Reserve continue on the path of easing. We'll talk about that in more detail. But we think the Federal Reserve, Mr. Powell and his constituents, are looking to maybe 1 to 2 interest rate reductions this year, which would be just a little bit of tailwind for the bond market. And the stock market also likes that when those interest rates do move lower. But it's a little bit of a dynamic, we use the word there, dynamic, a dynamic dance maybe, trying to get inflation down, but also trying to keep employment at a maximum high number that the economy can bear. And those are kind of the two mandates of the Federal Reserve. And so far, so good. What you can see there on the right and the light blue line are what we're forecasting for future employment numbers, which you can see we think there are fewer jobs being added month over month when compared to the last 12 or 18 months. But we do still think that that job growth continues to be positive, which is a good thing. The Federal Reserve has also said their goal of inflation is 2%. We think it's going to be hard to kind of get down to that 2% number. We think we probably end the year in that 2 to 3% range, which is where we find ourselves now. And it's, I think, worth reminding clients, a lot of times clients will say, well, inflation's moving lower, the cost of eggs, the cost of milk is still higher at the grocery store. When are those prices going to move lower again? And that's a very intuitive way to think about it. But what we're talking about when we're talking about inflation is not prices actually moving lower, just in prices increasing at a slower rate. So the price increases in the past are to some degree set in stone. And we're talking about what do we think the future increases here are going to be.
Matt, one thing just to throw in there is we get asked about cash. Past 2 days conversations talking to clients, money market reached a peak of about 5.5%, and that was really neat relative to where interest rates have been for a long time at virtually zero. That money market has moved from 5.5 down to 4.3. This slide is basically saying, hey, there's probably going to some additional slippage there. So if you need cash, cash is a great place to be when you need cash, but cash is not an investment long term. And again, this is the time where you sort of look at the upcoming year and say, well, are we trading cars? Are we adding on the house? So we got a big trip? Are we making gifts to charities, gifts, kids, grandchildren, etc.? Setting aside that cash and maybe re-looking at the allocation to an investment that's more probably going to be moving lower as far as interest rates are concerned.
Yeah, well said. And on kind of that same line of thought, inflation is actually back near to the pre-COVID levels. So end of 2019, early 2020. And so we saw a rapid increase, but as quickly as inflation did go up, it did come down almost as quickly. So not perfect from what the Federal Reserve wants of that 2% number, but tremendous progress has been made on the inflation front. We don't see a scare where we think inflation clicks back up to that 3, 4, 5% range. We think it stays where it is or possibly moves a little bit lower is our expectation over the next 12 months.
So easy question, where are interest rates going in 2025? Well, wish we were smart enough to know, but this slide, we have focused on the potential market scenarios for the yields on the government bonds, the treasury bonds, if you will. So you got a bear case where interest rates go greater than 5%, a base case about where they are now, and again, we're talking about the 10-year treasury at about 4.5, and then the bull case for interest rates move lower based on a number of factors there. And so we would fall into that middle base case. GDP growth somewhere in the 2 to 4%. Federal Reserve cuts rates 2 times in 2025. Remember, the Fed is cutting short-term interest rates. We're talking more here on some long-term treasury interest rates. There the inflation, the deflationary trend continues, and the status quo on the deficit. It'd be really nice if the government would find some fiscal sanity and just come close to balancing the budget. So who knows? As you know, if you're a client, our investment process for fixed income is indeed just that, a process, because no matter how smart you think you are, it's very humbling to try to predict interest rates or the stock market. It really can't be done. And so, again, looking at the trend, looking at the risk versus the return is something that we do in our investment policy meetings. And again, the base case, higher for longer, but rates certainly not going a lot lower is our expectation. Housing is something that is at the intersection of interest rates and the consumer. Higher mortgage rates make it more difficult for someone to trade houses, or someone that's getting married or wants to move out of a rental place to get a house. But housing activity obviously has slowed since the pandemic, when interest rates were really low. Affordability remains a challenge. Someone's probably saying, well, yeah, tell us something we didn't already know, Randy and Matt. But anyway, if interest rates do move lower, that would help. That's on the administration's mind as they try to make housing more affordable. Housing is a big driver of the economy as well. PE stands for price earnings ratio, the price of the stock divided by the earnings. And that actually has been the driver of the market until now. We'd love as investors to get what we call multiple expansion, more multiple expansion, where you're willing as an investor to pay more and more for a dollar's worth of earnings. However, underline that could change, as there's probably less room, some limited room, as we say there on the right-hand side, for additional PE expansion. And if you don't get PE expansion, then we need higher earnings to drive the market. If you're Costco or Johnson and Johnson or Boeing or Walmart, all those companies where you're making more money, that helps the stock price go higher. Obviously, not telling anybody anything they don't already know, but PE expansion and the earnings are the two drivers of stock prices moving higher.
Yeah, to oversimplify a really complex idea is strip out all the noise, the politics, the geopolitical tension, consumers, etc. If a company can grow their earnings, that stock price over time, in theory, moves higher. So we think it's a little bit more back to the basics from a standpoint, 2025 being companies that can grow their earnings are going to be the ones that perform the best. And this is more of a look, taking a step back, maybe looking at the forest opposed to the trees, dating back to 1928 through the end of last year. We think we are in a bull market. The typical bull market does last anywhere from 16 to 24 years. So we don't think we're in the first inning. We don't think we're in the bottom of the ninth inning either of this bull market. It's worth remembering, even during bull markets, the stock market has a 10% pullback historically once every year, and a 20% pullback every 2 to 3 years. So overall, we expect there to be pullbacks just because that is very common, historically speaking. But that being said, we do think we're still in a bull market moving forward. Kind of like Randy said on the bond side a few slides ago, this is our thoughts for the overall stock market. I want to focus less on the values of that S&P, the bull being 7,000, the base case of 6,300, and more think about it from percentages. You know, what Randy and I have been saying here internally within our investment committee meetings with Maddie, but also to clients, is we're not expecting stocks to move higher by 20, 25% this year. The same breath, we're not expecting a big pullback in the market either. So our base case, which we are applying, you know, a 50% probability of happening, that represents anywhere from 4 to 5% higher from where the stock market sits today. So if we get to the end of the year and the market's up 5, 6, 7, 8%, it's kind of our expectation. We think it's having some tailwinds of some pro-growth type of agenda from Trump, some deregulation. At the same time, also having some headwinds of valuations for a few of the technology companies, and we'll talk about that in more detail, being stretched, higher interest rates for longer. We think those competing forces could mitigate each other, and we end in a flat to slightly up market would be our base case.
Matt, one thing to add right there would be, if we are correct in our base case, 50% probability that we're not going to have another 20% year, and would we ever be tickled to say raise our hand and say we were wrong. But that, especially for the person that's retired, we talk about the old adage of mailbox money is good money. That shows the added importance and the comfortability of having dividends come in 4 times a year. And if you're making 7 or 8% on a stock, the expectation, and you can get 2 to 4% of that through dividends, then you put probabilities higher on your side. So especially in this type of a market, our, I would say, second secret sauce, which is dividend stocks, becomes even more important and more helpful for the smooth ride.
So what do we do if we think valuations are a little stretched? We said earlier, we think earnings growth, companies that can grow their earnings, that's going to be the real vital thing to pay attention to. The valuations are mostly stretched for what we call the Magnificent Seven, is a term that's been used, or just the 10 largest stocks within the S&P 500. So there's become a real concentration there at the top of the market. We haven't seen this large of a concentration in such few names dating back approximately 25 years to 2000, 1999, 2000. So what we are recommending to clients, we do own a few of those names, but a vast majority of the names that we own for clients within the dividend stock portfolio are companies outside of those top 10 names. And if you look at the numbers, a lot of those other 490, so not the top 10 in the S&P 500, but the bottom 490, a lot of those we think are a lot more fairly valued, fairly priced, and have room to grow their earnings like we suggested earlier. So we still like technology, healthcare, industrials, to name a few, but we think focusing less on the index, because the index is almost 40% concentrated in those top 10 names currently, and more on the other 490 stocks is some prudent advice to at least consider moving into a new year.
So if you're investing in 2025, do you invest in the good old USA, or do you diversify and look at some international stocks? Our joke has been that the U.S. economy is the cleanest shirt in the dirty laundry. But going forward, chart on the left, United States is expected to see the strongest economic growth. A lot of that from lower interest rates, a lot of that through perhaps some deregulation, a lot of that through the optimism of the new administration. And despite continued outperformance, the earnings per share growth is expected to remain on top in 2025. The emerging markets, which has a substantial more risk than the United States, would come in second, and you can see the rest of Europe is down there on the bottom. But we continue to say that you can get some international exposure from owning companies that do business places other than just the United States. So our portfolio has been and continues to be primarily U.S.-based stocks. At some point, there's going to need to be a pivot, but it's for right now, we're still comfortable with where we are, and we'll so going forward until the facts show us a change. U.S. dominates in the global landscape. 63% of the top 100 global companies right here in the good old USA. 50% of the venture capital money right here in the good old USA. Europe, market cap 1.7 trillion is there. You can see on the right, the market cap of everything here, 28.3. Obviously, that's skewed by the some of the Magnificent Seven stocks there. But again, it is what it is. And you make your investments and you have a process and you follow through with that process. You look at it on a regular basis, but the client tells us, we want to get there from here. We want to raise, and we want to take less risk in the overall market. What's the least amount of risk that I need to take to get there from here? We'll continue to focus on high quality dividend paying stocks. The great thing about dividend paying stocks, there's an old saying is the safest dividend in the world is the dividend that's just been paid or dividend that's just been paid and raised. And we love the fact that we're getting income from stocks. And if we're doing our job right, we'll get an increasing income as companies raise their dividend. So we will always default toward dividend paying high quality and also some fixed income to act as ballast there. This is just what we'd call a scattergram chart where we show the rate of return on the left-hand side going up and down, starting from 0, going up to 12%, and then going from left to right. You look at the standard deviation, or another fancy word just for risk. So the perfect investment would be on the top, the northwest quadrant, left-hand side, very high, very far left. And the worst investment would be bottom right-hand corner. And so you can see there historically some of the risk return attributes of the S&P 500 or small stocks, the emerging market stocks, the Europe, Asia, Far East, the EFI, commodities, etc. And so, again, we like hanging out in that safer, more secure, show me the money type stocks. But we will especially continue to focus on fundamentals in 2025 for our investment portfolios.
Well, let's take a look here. First year of a presidential cycle, what does that typically look like? Draw your attention to the top of this busy slide. And in year one, the median performance of the overall market is just above 8%, which is actually in line of kind of our expectation for the year. And the market is positive just about 58% of the time. So it is not the weakest of the four, but it does come in third place. So if the glass is half full, you could say at least meddled. If the glass is half empty, you could say it's in the bottom 50% there. But not a bad year to be a stock investor when compared to maybe the second year of a stock market presidential cycle. We also wanted to look just with Republicans taking not only the White House, but the Senate and Congress as well. What does that look like? And what you can see here is when Republicans control all three forms of government, that annualized return is also very close to 8% per year. Markets up almost 80% of the time when that has been the case historically. So we like to say history does not repeat itself, but it does often rhyme. And so we're trying to look at this just through a number of different lenses to see if anything does stick out from a standpoint of something being peculiar from an investing perspective. And this would be, Randy mentioned it earlier, we get the question, what keeps us up at night? It would be the national debt. And here specifically, this is the number of pages published for federal regulations dating back to 1950. And you can see there's just more and more pages being published year over year. We think the tide could possibly turn. Don't hold our breath. I don't think it's tomorrow or possibly next week, but fast forward a few months, I think we could see some of this regulation, this red tape moving lower. Hopefully that translates into a lower cost to run the government. You know, the government spending for our economy can act as a short-term sugar high, but long-term, it's more of a drag on economic performance and growth specifically. So we would love to see this type of regulation moved lower, and the government obviously spending less money than they are today.
So a lot of information presented here. Things are in constant flux and change. You're recently retired. Welcome to the world of investments. But we think a great idea is for you to have your own personal holistic wealth plan. Here at the Price Group, we call it a Live Well plan. perhaps a little bit corny, but it's genuine. And our clients, and we want our clients to live well. So if you've got a live well plan, this is the point in time where we review for anything big that perhaps be coming down the road. If you've never done this, a meeting with the price group will help you get started on this. Again, our goal is clarity. For the first time, people many times come to see us, and we call it the aha moment, where first time they'll have clarity about where they are. They'll get confidence, knowing where they are and knowing where they want to go, and that will lead to comfort as it pertains to their financial future. So on a regular basis, we sit down with folks to do this. There's not a cost or not an obligation. We tell people that if there's common ground, we'll both know it. If not, we'll shake hands, we'll part as friends, and you'll go away with some information and for some help that will be of value to you as you look at your financial future. So we would invite you to do so. We've got some additional information on our website. That's the team there: Preston, Tiffany, Maddie, myself, Matt, and Melissa. You're more than welcome to reach out with any questions or comments, phone numbers, email, etc. And so we'll end with stay warm. Again, Happy New Year, and we are here to help. Hope to talk to you really soon if there's some common ground and we might be of assistance. Take care. Have a good rest of the afternoon. Thanks again for joining us.